The next thing I want to talk to you about is installment agreements or payment plans. So the IRS is famous for accepting payment plans for liability. They recognize that taxpayers who may owe large liability may not have all the money up front. Therefore, in order to get back into compliance, they need to be put on a payment plan. So there are 4 types of payment plans that you should generally be aware of. The first is what's called an automatic payment plan or an automatic installment agreement. An automatic installment agreement is an installment agreement by right. So if you owe less than $10,000, the IRS is statutorily required to put you in a payment plan if you request it. So that's a very powerful tool for taxpayers who have smaller liabilities, and you can call the IRS, put them in a payment plan immediately without much consideration to their financials. The second type of installment agreement is what we call a streamlined installment agreement. So taxpayers who owe $25,000 or less, or in certain cases $50,000 or less, can apply for a streamlined installment agreement. A streamlined installment agreement is usually over the period of 60 months, and the IRS will take the taxpayer's liability, divide it by 60 months, factoring in the interest and penalties that are going to accrue over the life of that 60 months, and will put the taxpayer on kind of an automatic installment agreement. If the taxpayer is under $50,000, generally speaking, financials will not need to be provided. So that's an effective tool to have if your taxpayer is looking for quick compliance and will accept a generally formulaic payment plan. So for example, if your client owes $50,000, your plan is going to be about $825, $875 a month. If your taxpayer is willing to accept that, that's a really fast way of resolution. Call the IRS up, say, I'd like to put my client on a streamlined installment agreement, and the benefit to a streamlined installment agreement is generally most of the time with liabilities that are under $25,000, it happens all the time. With liabilities that are under $50,000, it happens most of the time, but the IRS will not file a lien against the client. So if you put the taxpayer into a streamlined installment agreement, then the taxpayer will not have the threat of a lien, which is a very powerful tool. The last type of installment agreement is just your run-of-the-mill standard installment agreement. If your taxpayer owes liability that is over $50,000, the IRS will generally require financial information. Now, it's important to note that over that $50,000 mark, the taxpayer is out of qualifications for a streamlined installment agreement. Installment agreements above the $50,000 mark are not a matter of right. So the taxpayer is not guaranteed an installment agreement. If the taxpayer has sufficient assets, particularly cash assets that can be used to full pay the liability, then the IRS is going to want that. The famous saying of IRS revenue officers is that the IRS is not a bank. So if you submit financial information that shows $50,000 in cash or other liquid assets, or assets that could be potentially sold to pay the liability, watch out, because the IRS will want those assets sold to satisfy the liability in lieu of an installment agreement. Financials for taxpayers are generally covered on 3 forms. The most simplest of collection forms is what we call 433F. It is just standard basic financial information. There is another form called a 433A, and that is a more detailed financial statement. And then we have what we call a 433B, which is a financial statement for a business. Now, the IRS requests these financial statement, number 1, to analyze the financial position of the taxpayer, but they also use these collection statements as tools to go after possible levy sources if the taxpayer defaults. So when you read through these financial statements, just be advised that you are submitting a treasure trove of information to the IRS that they can use to potentially levy accounts. This is really a really important consideration for businesses. So if businesses list their accounts receivable on the form, then those accounts receivable can potentially be subject to levy later. So it's really important if you represent a business client who is being asked to fill out a 433B and asked to list their accounts receivable, that potentially you work with the accounts receivable to get their accounts receivable solved before you have to submit the 433B.